Welcome to this webinar hosted by SA Accounting Academy, creating opportunities to connect our partners to succeed. Our CPD policy is compliant with IFAC IES 7, which is the international standard set by the International Federation of Accountants, which relates to continuing professional development. Subscribers also gain access to various rewards. These rewards include discounts, reduced premiums, and other free stuff which is accessible through your online profile. These are our reward partners. The webinar recordings, slides, additional material, and assessment will be available at the end of the webinar within your online profile. You can claim your CPD for this webinar at the end of the webinar through your online profile after you have successfully completed the associated assessment. Whilst every effort has been made to ensure the accuracy of the presentation and handouts, the presenters, authors, and organizers do not accept any responsibility for any opinions expressed by the presenters or author, the contributors or correspondents, nor for the accuracy of any information contained in the handouts. Copyright of this material rests with SA Accounting Academy, and the documentation or any part thereof may not be reproduced either electronically or in any other means whatsoever without the prior written permission of SA Accounting Academy. Feel free to ask your questions during the webinar in the chat. These will be addressed in the formal Q&A at the end of the presentation.
Yet another webinar. This one is on dynamic approaches to budgeting and forecasting. Just as we begin, I think let me just put it to you that we have a lot to cover and the time that we have is relatively short compared to probably all the other webinars that we've had this year. So we'll be moving very, very, very fast. So what I've tried to do is to make the slideshows very detailed so that if anyone wants to go through, at least they can read the slideshow and they're going to make sense, because we're going to really, really move very fast. We have 72 slides, give or take, and we have 1 hour to cover all of them. So having said that, and I'm seeing people are signing in, very good. Well, you've met me. I've done a number of presentations, so I think you know a lot about me. I'm not going to go through that. We're going to start right on it. So beginning of the year, I think in February, I did a presentation on strategic planning and strategic management. And it was a perfect time to have a topic like that because we're beginning the year and everyone had a whole year ahead and we're all looking forward to having the best year, especially post COVID-19. And I think it was a very nice webinar. And SAA couldn't come up with a better time to have another webinar on dynamic approaches to budgeting and forecasting. Also, as we are about to conclude the year and start on a new one, I'm sure a lot of people are now busy in the planning and the budgeting process for the coming year, next year. But here is the research. It says that many organizations that have a systematic process for strategic planning, when they look at what happened during the year, they wonder how they were supposed to link the strategic plan and what happened during the year. So they don't really know what happened. They can't explain what happened during the year. It's because they did the plan and they put it on the shelf and let it there to gather dust. And here is another fun fact. 95% of a company's employees don't actually understand the strategy. Mostly, they don't even know what the strategy is. So if you picked a company's employee and said, okay, what are you guys trying to do? What are you trying to achieve? They don't really know much about that. So today we're going to be looking at that. Maybe just to collect a few statistics before we start the sprint. how many of us here work for companies that actually create budgets? Just if you work for a company that actually creates budgets, just say, I do. Okay, I see somebody does. And how many of us here work for companies that during the course of the year, they monitor their performance vis-a-vis the budget? If you do, also please type, I do. That's good. Well, that's nice to see that some companies here actually do that. And there are some that never actually do that. Some do the budget, some they don't. And yeah, okay. So it's good that your company does that. And at the end of the webinar, I'll try to leave about 10 minutes so that we're able to ask some questions and have some discussions. We will see how fast we would move. And this is going to be a sprint. We all know that all of us here, by and large, are accountants, and budgeting and forecasting are core functions of the accounting and finance team. Organizations depend on the expect these functions to be actioned and coordinated by their accounting and finance. And this is largely because of our ability to forecast and our interaction with numbers on a day-to-day basis. Yes, Stephen, you are right. Mostly SMEs and family-run businesses do not really do budgets. They operate by the blood. So we've all read the advert to this webinar. We know what we expect to cover in this budget and what sort of we expect to take out of it. Let's jump into planning. What is planning? You would think that businesses are going to spend a lot of time actually planning because it is always linked to doing well as a business. You would think everyone understands how important planning is. But that is not actually necessarily the case. You know, Tim Berry is a researcher and he writes about business. He's a published writer, author of business strategy and planning. He says that most companies all over the world, he would say only about 10 to 15% of companies that he's encountered in his career have an effective business planning process. So there's some that have a planning process. You know, every year we like going out in a nice resort town for a strategy session. But by and large, that strategy session is never really effective. And so about 10 to 15% actually are engaged in a very, very effective planning process. And what is planning? Planning is the function of management that involves setting objectives and determining a course of action for achieving those objectives. Planning requires that managers be aware of environmental conditions facing their organization and try to forecast those conditions into the future. So they have a near accurate way of determining what they feel is going to happen in the future, or at least have some plotted course of action in the event that event A happens, event B happens, event C happens. How is management going to handle that? Planning is about managing resources and priorities in an organized way. So basically plans are grouped into, there are several ways of actually grouping business plans or business planning. However, today we're going to focus on 3 ways, and in the 3 ways we're going to look at just the one that is based on hierarchy. So the first one is based on hierarchy, which is corporate plan. The corporate plan is also what others refer to as the strategic plan. There's the tactical plan, there's the operational plan, and there's a contingency plan. Mostly, I know that people that went to business school, they may not have covered contingency planning. However, it has become very important, especially in today's age where uncertainty has probably become much more of a business risk, of a normal course of business than it was before. In South Africa, we now have inflation that we probably never, we had it, but it was probably relatively very low. But now that it is growing and we have it now, so contingency planning is now part of the normal planning process. Then the other grouping is based on use, single use and standing use of business plans. Then the last grouping is going to be based on flexibility, We have specific plans and we have flexible plans. Because of the broadness of the topic that we're covering today, we're not going to look at the one that is based on use and the one that is based on flexibility. We're just going to focus mainly on the one that is based on hierarchy. So in the planning session, we're going to look at the characteristics of planning, the key considerations in the planning process, the role of finance teams in planning, and the cost of lack of planning. So strategic planning, which is also what is usually referred to as the corporate plan, seeks to answer the why question. Why is the business doing what it does? Why are we doing? Why do we exist? That's what the corporate plan wants to answer. It turns out that a lot of people aren't entirely clear what a strategy or strategic plan is. People think they are clear, but mostly they are not. Here, we are fortunate because we have a group of people that are in this webinar that are accountants. So they probably already know what we're talking about today. But other people that you have to interact with in your businesses don't have an idea. So most people confuse the organizational goals, objectives, and motivational slogans, and oftentimes end up creating an operational or the way and where plan, business plan, or the who and the what kind of plan. Remember, we said strategic planning answers the why question. So the when and the where question or the who and the what questions are not what seeks to be answered by the strategic plan. We're going to be the best is a slogan that we may all use to rally ourselves, that we know what we want to be the best in the industry, want to be the best accountants, want to be the best this. But that's not a strategy. That's just a slogan that we sing. So a strategy then seeks to answer, why do we do what we want to do? That's the biggest question that the strategic plan wants to answer. The strategic plan gives you a long-term view of goals and explains how your business, your organization will gain a competitive advantage and be the best in your industry. That's a strategy. It's a long-term view. It provides a basis for monitoring progress and for assessing results and impact. It facilitates new program development, enables your organization to look into the future in an orderly and systematic way. So it looks way beyond 1 year, 2 years. It's usually focused at about 10 years. We want to say, what do we want to be in 10 years? What is our mission? Why do we exist for the next 10 years? With continued global volatility and inflationary pressure building in the marketplace, your organization's strategic plan should be taking center stage as you move to mitigate potential impacts. Here is our strategic planning best practices to get you started. So think about this. If you existed in business prior to COVID-19, would you have had a plan that is robust to respond to what happened because of COVID-19? If you exist in business now, do you have a robust strategy that you formulated that will help you exist past inflation, that will help you navigate the inflationary pressure that we're experiencing in South Africa today? So that is a strategic plan. Then let's move on to tactical planning. At the tactical level, there are many specific and short-term plans where the actual work is being done. The support the high-level strategic plan. So we've broken down the strategic plan into many small chunk bites plans that are meant to support the strategic plan. So this is the how. So we've set out the strategy. We're saying, how do we achieve that strategy? Who do we put where? What time do we do what? And when do we do this? What do we do? So this is breaking down that bigger plan into smaller chunks. With a tactical plan, there are specific questions that need to be answered about what it will take to accomplish the goals set in the strategic plan. The most important question being how the company will accomplish the mission. This type of planning is very focused and short-term. Tactical plans are sometimes flexible and often break the strategy down into several parts and assign actionable tasks to each part. Oh, by the way, if you have any questions or comments, just put them on the chat so that we're able to see them, and then we will attend to them as and when if I see them and I know that is going to be covered somewhere in the webinar, I won't answer it, but whatever I can answer right away, I'll just cover. Then we have the operational planning. The operational planning seeks to break down the tactical plan into smaller bites. Those who remember that, the ones that attended the webinar on strategy in the beginning of the year, we did say that we may have a big strategy that we're trying to achieve, and tactically, going down to the tactical plan, we may tactically want to deviate a little bit from the strategy that we set, from the bigger strategy that we set, to probably achieve a competitive advantage in an area, or we've identified a course of action that allows us to deviate a little bit from the strategy to take advantage of something that is happening in the market. And the example that I gave was that because of COVID-19, there are some companies that were in the supply chain management that saw other opportunities that opened up, that sort of deviated from their core strategy to take advantage of what the market presented. And to do that, we use the operational plan, because the operations are the cables that we're pulling every now and then to make sure that we're achieving all our strategies. So this basically describes the day-to-day running. The problem of having a day-to-day plan that doesn't fit into the larger strategic plan is that we may actually get carried away on the day-to-day and end up forgetting everything else that the day-to-day is supposed to achieve. If you're accountants in the audit field, and you're trying to grow a business, it is very easy to spend a lot of time. I mean, if you're at strategic level, if you're a partner or somewhere there, it is very easy, especially in smaller firms, it is very easy to get busy with small little things, small little details, and forget the core mission. That's the reason why the biggest thing that you need to do is to set the bigger strategy, so that all the small little efforts that you put in every day is meant to feed onto the bigger strategy. I hope this makes sense. Again, we're moving very, very fast because we're trying to cover a lot. So contingency plans are made when something unexpected happens or when something needs to be changed. So we now need to have a contingent planning process to say, okay, if things don't go according to plan, what do we do? It's called the plan B. We now always refer to plan B. And I know there are a lot of people now that are saying, no, you should not have a plan B, because once you have a plan B, then plan A is not going to work. But the truth is, that's the reason why in investments we hedge risk, because we know that risks are associated with the unknown, and the unknown is associated with planning. Planning means we're trying to see what the future is likely to look like, and we're trying to plan our course of action into the future, but we don't know what's going to happen in the future. So having a hedge to say, if the unexpected happens, we know how we're going to respond. That is called a contingency plan. So what you need to have in your business is a robust contingency planning process that enables you to engage a contingency plan if things don't go according to your plan. So contingency planning can be helpful in circumstances that call for a change. Although managers should anticipate changes when engaged in any of the primary types of planning, contingency planning is essential in moments when changes can't be foreseen. So when we are planning, remember, when we are planning, we're trying to build onto the planning model or whatever we're using to plan for the future, whatever changes we think are likely to happen. For instance, we already built into the budget the inflation, because we know that our inflation is somewhere between 7% and 8%, others say 7.6%. We built that into the plan. So we know that the prices are going to go up by roughly 7.6%. So if that happens, we've already planned for that. However, if our inflation, God forbid, tends to be hyper, and then we go way beyond 7.5%, how do we respond to that? Now, that is a contingent plan. So it's about those changes that we cannot anticipate. We know we are likely to meet changes in the future, but we cannot anticipate what change those changes are going to be. So, what are the characteristics of planning? Number one, planning is the primary function of management. If you are a manager in your business and you're not involved in the planning process, then know that you are busy with the nitty-gritties of business. You are busy with the trees and missing the forest. Your primary job as a manager is to plan, is to have a broader view of things, so that whatever small little things that happen in different departments, you know that it's fitting into the bigger picture. When I was at college, my lecturer used to say, accounts clerks' jobs is to know how things are done. the job of the finance director is to know why things are done. So people that are busy with the nitty-gritties, they know how those nitty-gritties are done, but they may not have an understanding of why they need to be done to achieve the broader picture of things. Then planning also focuses on objectives. That's the reason why we must have a strategy, so that we know the objectives that we want to meet. Then the plan is meant to meet those objectives. So first of all, we have to determine the objectives or the goals of the company, and then lay down the means that we're going to employ to achieve those objectives. That is planning. Breaking it down into strategy, operational, tactical, contingents, that's just breaking down the means of achieving the objectives. But we must have the objectives first. And also, here's another thing: planning is a function of all managers. Every manager must plan. So, and every department, whether you're finance, operational, marketing, whatever department that you're in, you must have a plan. And that plan must, so to avoid strategic drift and goal incongruence, that actually ensures goal congruence. All plans must feed onto one strategy. That means no one one department is going to be fighting against another department because the other department's goals are now not feeding, or they're now not congruent to the other department's goals. Planning is an intellectual process. You must think about what you're doing. It's not an issue of putting a number and tracking on an Excel spreadsheet when we're preparing a budget. You must interrogate the numbers. Do they make sense? Have them make sense? Prepare the numbers and think about it. And we're going to look at it in the budgeting side, that more than employing your mind, especially when you're dealing with other people, you must also have an emotional buy-in, an emotional commitment to the planning process from other people. Because you can have an intellectual meeting of the minds with other people in other departments, but if that intellectual connection is not met with the emotional commitment from them, it's not going to happen. This is an idea that I actually got from an author called Strive Masiwa. I know some of you may know him. In his book, How to Build, I think it's a multi-million-dollar company in Africa, something like that. He talks about having an intellectual commitment from the partners that we are working with. Also, planning is a continuous process. Planning is not stagnant. You don't plan now and let it be. That's why I asked if anyone works for a company that after the planning process has happened, they sit back every now and then to revise, to go back to the plan and see how are they doing vis-a-vis the plan. Are they straying? Are they still within the plan? Is there anything that can be done to beef up the plan? Should the plan be changed? Planning, I mean, we're auditors. We know that audit planning and risk assessment is actually a continuous process, because every time you make something new, you must think about how you're going to do it, how you're going to handle it. In the business, you need to think about, okay, are we still moving in the right direction, or what's happening? Planning is also very dynamic. It's not flexible. There is not one way to plan it. There are changes, there are modifications that should happen. Planning secures efficiency, economy, and accuracy. If you don't plan, you won't know how much you should be spending. So you don't even know if you're spending too much or you're spending too little. You're just moving blindly. Planning involves forecasting. It talks about looking into the future. I've already mentioned that. And planning has its own limiting factors. You know that you have money, that is a limiting factor, because the resources are never enough. Equipment, materials, even people. You are planning, but you never actually have enough people to execute. Everyone wishes they had more teams. So what should we do? What should an organization consider when planning? So one, you need to determine your strategic position as a company. Where are we vis-a-vis where we want to be? Before you decide where you want to, well, you know where you want to go. Before you decide how you're going to get there, you need, first of all, need to know where you are. When you put your GPS on your phone, it first of all locates where you are. Then vis-a-vis where you want to be. Prioritize the objectives. Know that your plan is meant to meet an objective. Then develop the plan. Execute and manage the plan. Then review and revise the plan. We've already mentioned that. So for a strategy to be successful, you need the right mix of people, and it must be cross-functional. You cannot sit in a silo and say you are creating a strategy, because no matter how high you are sitting in the organization, you may not be in a position to know everything about what is happening in every department. So what you need is to sit with all the people that work in different, the operations, the marketing, the finance, everyone. Let them come in, and this helps because you get to know what's happening in every department, and you also get an emotional buy-in on the strategy that you are working on. And another thing that you must be careful about when you're planning, and if you've brought in a lot of people, is to understand that people generally have assumptions, or they have perceived notions about the organization, about the future, about what's going on. Even right now, we know that we're in an inflationary environment in South Africa, and people have their own preconceived ideas of how they should navigate what is causing the inflation, and how they should navigate and deal with it. So because of that, when we are planning, you need to know that people have those preconceived ideas, and when they are bringing in their ideas, you need to view those ideas in light of their preconceived ideas. And also, here is another fun fact: you also need to know that you also have your own preconceived ideas. Therefore, you must also consider your own preconceived ideas. Sometimes our preconceived ideas are not necessarily factual, it's just our view of things. And so we must be intelligent enough to know that our view of things may be wrong. So that's the reason why when you are planning, you must gather data, both internal and external data, because data doesn't lie. No matter what your preconceived idea is, data is going to tell you what the real things are. Of course, there is a cost to gathering data, but always the bottom line is be aware that you have your preconceived ideas, your team have its own preconceived ideas and notions about what's happening and what needs to happen. So take those preconceived ideas and sift them and see what works and see what doesn't work. My apologies again, we're really trying to move very fast and cover as much ground as we can with the time that we have. So when we are planning, always make sure that you reaffirm your mission. How many people actually know the mission of their company? Not the mission statement. Anyone can memorize the mission statement, but how many people actually know the mission of the company, the vision of the company, and the values of their company, and the strategy of their company? It's a good time when you are planning to make sure that everyone has an understanding of the mission. Reaffirm the mission. What your organization does, and how is it different from everyone else around you? And your vision is what your organization will look like in the future and what you want to achieve in the long run. I like the first part that says not what you want to achieve, but what you think your organization looks like in the future. That is a future projection of your organization. Your values, what is it that your organization is actually not going to do? What are the guardrails that you have in your company that you say, you know what, we can go this far, but this we want to do? Other companies, no values, anything goes as long as it brings money through the door. Then the most important thing also about one of the most important things in the planning process that you need to consider is transparency. You cannot get an emotional buy-in from your colleagues if you're not being honest about the thing. Stakeholders want you to be open about it. And if you're the one that is leading a planning session, you need to be vulnerable so that you get an emotional buy-in. You need to be vulnerable and show them that there are things that you don't know. When you are asking them, ask them genuinely. Sometimes we gather people around, we ask them so that we hear their opinions, so that we don't really, so that we just want to make them feel like they were involved, but we know that it was just superficial. They were never involved in the first place. So it is important to acknowledge, and your leadership team may not have the right tools, the capabilities or knowledge or understanding of how particular things work, and engage everyone so that you gather that knowledge. Think past the strategy plan. Strategy execution is just as important as planning. It's not just the session that is important. It's the execution. That's the reason why I asked, do we go back and see that what we're executing is what the strategy says we must execute? There are times that when we get to execution stage, we actually don't execute the plan. No matter what you're doing, I've seen that. I've been a student. I know that you have a study timetable, a study schedule that you've set there. You're saying, I'm going to follow this. But when it comes to actually doing it, you are off. You're supposed to be studying for 3 hours, but you study for 2 hours. You convince yourself that you have the right understanding. You leave it. It's very difficult to stay on course. So always try to stay on course as a business. Also, when you are planning, define your KPIs. Know when you are winning and when you're not winning. How do you define if you are meeting the objectives of the strategy or you're not? Keep this thing simple. Understand that, okay, if we're doing A, B, C, D, E, then we're winning. If we're not doing A, B, C, D, E, then we're losing. And also try to look beyond revenue and money, and don't have goalposts or don't move goalposts or ignore them. So you have your KPIs. Make sure that those KPIs are beyond revenue and money. As a company, people pay for the value that you give them. So it's not about the money. Money is a result of the good work that you are doing. So focus on those things. Try and incorporate more than money and revenue into your plan. Then you must commit to action. Change is very difficult. No one wants change. People get frustrated when they have to change anything, when people have to change accounting system, whatever it is that people must change. People don't want to change. It's a painful process, but sometimes it is necessary. So when you are going to go through a change in whatever you are doing, make sure that you are committed to actually doing it. Again, let me reiterate that the lecture notes are available, so you can download them and read anything that we sort of are skipping over, because we're trying to cover a lot more with a very short space of time. So you can download that and you can read at your own time. They are fairly detailed, so you should be able to download them. Then the question is, what is the role of finance? We're all accountants here. What is our role in the planning process? And here is the thing. Money plays a role in building up and observing explicit and quantifiable objectives, and accordingly empowering the firm to work proficient and viable. When we've done everything that we do as a company, it all gets down to one thing. Are we winning or are we losing? And if we are winning, the bottom line is up. If we are losing, the bottom line is negative. So everything boils down to money. So because of that, that's the reason why finance plays a critical role in the planning process. Finance gives us the budgets and the goals. These are financial budgets and these are financial goals. Budgets are always financial. We need to know how much expenses we should be incurring, how much revenue should be incurring, how we should be making to cover the expenses that we're incurring. Economic value, the estimation of how much money should the business be making to be making economic value, and how much it should be losing to be destroying value. That is all a function of accounting and finance. Free cash flows. This is a very good metric because it tells us if we don't have free cash flows, then it's very difficult for the company to grow. We must have free cash flows. So this helps in determining if the company is going to grow in the future. It determines what future investment the company can make and where the company needs to cut. So finance brings these matrices together in the planning process. Finance also helps in the asset management process. How much money are our assets generating? Do we have assets that are now losing money? That information comes from assets. Should we be buying assets? Should we be selling assets? Should we be disposing of business units that are no longer performing? What should we be doing? That is the role of finance. Then financial decisions and capital structure. This is actually the bigger part of finance. What kind of capital should you be raising? Should you be issuing shares? Should you be getting debt? What is the optimal capital structure? How do we lower the cost of capital? And if we want to get this optimal cost of capital, how do we play around with our capital structure to achieve it? That is the role of finance. Risk assessment and management. This is also very important. Finance is responsible for determining company risk. The board obviously would have set the risk appetite of the company. This is how much risk we can absorb. No matter what the business that you're in is, there is a certain level of risk that you can stomach. And there is a certain level of risk that you say, you know what, beyond this, we can't. And the role of the board is to make sure that our risk-adjusted returns are high. So this is how much return we're making vis-a-vis the risk that we're incurring is something that we can stomach as a company. And the process of risk assessment and management lies with finance. And then the overall development. In different companies, the role of finance, you will see that it differs because it depends on the industry, it depends on how your company is structured and everything. But development, if a company is to grow, the bulk of the advice that the management need to use to grow is going to come from finance. So you cannot do a business plan without having finance playing a major role in it. Does the lack of planning or poor planning have a cost? The picture this tries to demonstrate what happens if we didn't plan properly, or if we didn't plan it. Or you can see that the other team was building a bridge, the other team was building a bridge that was supposed to meet in the middle, and they didn't. And this is what happens when we're planning. When we fail to plan and our plans are poor, we tend to destroy value for the company. So if there is a lack of planning, or there is poor planning, we don't know how to allocate material resources. You are going to be manufacturing, then you discover that the key resource is out of stock. You can't proceed. In finance, you don't know when you're out of money, when you should be tapping into that overdraft facility. You don't even know how to plan to get a loan at a certain point in the future, because you haven't created a plan. So planning is very important for these two reasons. And then human resource productivity. Planning helps us make sure that we've equipped human resources with the right tools so that it performs. Remember that there is capital plus labor. That's what increases our return. This is economics. So if our productivity, if we have labor but we don't have capital, then our labor is not going to produce much. If we have capital but we don't have labor, our capital is not going to produce much. So we need to know the optimal quantity of labor and the optimal quantity of capital. That yields the highest return. Planning also increases human resources morale. There is nothing that frustrates employees more than working in a company that is disorganized, where anything goes and everything goes. It is so frustrating. You would start losing talent. Good people will start leaving. So for you to boost employee morale, first of all, you must have a proper plan in your business. Secondly, you must also involve the human resources in the planning. By human resources, I'm not referring to HR, but I'm referring to the people in the organization. They must be involved in the planning process. Now, we're moving on to budgeting. What is budgeting? Budgeting is the process of creating a plan to spend your money. Remember, we said planning is business planning, setting the strategy, setting the tactical plan, setting the operational plan, and setting the contingency plan. Then we're saying, how do we execute the plan? Executing the plan requires us to have a budget. A budget is the financial breakdown of the plan that helps us to execute it. Creating this spending plan allows you to determine in advance whether you will have enough money to do the things you need to do or would like to do. If you don't have enough money to do everything you would like to do, then you can use this planning process to prioritize your spending and focus your money on the things that are most important to you. This applies to individuals, this applies to companies, this applies to governments. A budget is important across board. No matter who you are, no matter what you do, it is important to have a budget. So there's a relationship between budgeting and planning. And I've just thrown in there again the relationship between all these and forecasting. So planning, budgeting, and forecasting are typically a three-step process for determining and mapping out an organization's short and long-term financial goals. Planning provides a framework for a business financial objective. Budgeting will come in and detail how the plan will be carried out month to month and covers items such as revenue, expenses, potential cash flow, and debt reduction. Traditionally, a company will designate a fiscal year and create a budget for that year. Well, we all know that. So we budget for the year and we execute the budget during the year. Forecasting takes historical data and current market conditions and then makes predictions as to how much revenue an organization can expect to bring in over the next few months or years. Forecasts are usually adjusted as new information becomes available. So a forecast is not a budget. A budget details how much we should be spending. A forecast tells us how much we are likely able to be spending, or how much are we likely able to be making as revenue if we're forecasting into the future. There's usually a very thin line between the two, and people sometimes confuse the two terms, but it's because also they sort of work together in that sense, in the sense that they are three stages in a three-staged process. All right. So there are different types of budgets that we're going to look at. We have an incremental budget with an activity-based budget, we have a value proposition budget, we have a zero-based budget, we have a driver-based budget. In the comments box, can you just type what type of budgets you think your organization prepares on an annual basis for those companies that actually prepare budgets? So an incremental budget is also known as a traditional budget. It's probably the most common form of budgeting. This is generally, we start with the previous year's figures. We know how much we did last year, the actuals and the budget. Then we make that a baseline, and then we can either inflation adjust those figures so that when we're budgeting, we're taking the last year's figures, our revenue was, let's say our expenses, whatever expense it is, was 50,000 rand for the year. We inflation adjust it so that we inflation adjusted by the inflation rate, then we get to whatever the figure would be for the year, and then we try to work towards that. So that is an incremental budget. So it really builds on the previous year. There are disadvantages to this, obviously, and the disadvantage to that is that the disadvantage of the incremental budgeting process is that if there were inefficiencies in the last year, we are actually sort of carrying forward. We're inheriting the inefficiencies and going with them. It is the easiest way of doing it, but if it doesn't mean that if our cost for last year was 50,000, we must continue incurring that cost. I think a better approach would be to say, should we even be incurring that cost? Okay, I can see people are doing APP, others are involved in incremental budgeting. Yes, I know NGOs are going to do an activity-based budget or a zero budgeting because they must justify what expenditure they're building into the budget. Then the second part is the second bit is the activity-based budget. This one is usually a top-down approach that focuses on the key outcomes a business intends to achieve. It begins with the end in mind, then explores the questions, what must we do as an organization to achieve our primary goal? So we start with, okay, these are the goals that we want to achieve, and these are the activities that we must be undertaking to achieve those goals. Then we say, okay, these activities are going to cost money. How much money are we going to pay? How much money are we going to spend on this activity? How much money are we going to spend on this activity? How much money are we going to spend on this activity? So that is activity-based budgeting. So it tends to try and build into the actual strategies and budget in terms of what we must be doing as an organization. The problem with activity-based budgeting is that you can easily discount or overlook departments that fail to produce specific or measurable outcomes in services of the company's strategic objectives in the process. Because if a manager in a department cannot justify why an activity must be carried in the first place, or why that activity doesn't have, if they have an activity that doesn't really have a tangible outcome, it can be discounted, and yet that was a very, very key activity in the business. Those who deal with activity-based budgeting, they understand that, especially in non-governmental organizations and not-for-profit organizations. You notice that activities like finance and all, they don't really get much attention in the budgeting process, because the bulk of the budgeting work goes into budgeting for the core functions of the organization, whatever your NPO exists to achieve. Then the third one is value proposition budget. This one it examines each line item of budget category to ask the questions, why are we even spending money on this? What value does this provide to our customers? What value does this provide to our employees? What value does this provide to our stakeholders? So we're sort of trying to attach a monetary item to the value that a particular activity or a particular budget line item provides to stakeholders. So it tries to sort of sit between a zero-based budgeting approach and a traditional budgeting approach in that it doesn't really question everything as a zero-based approach, as we're going to look at it. But it sort of tries to sit somewhere in the middle. Unlike activity-based approach, value proposition budgeting seeks to justify expenses for the value they create without requiring a direct link to a strategic goal, as it were. Right. Then zero-based approach is when we're actually looking at the budget and we're actually starting from zero. We're saying, okay, why are we incurring this cost? Why are we incurring this cost? Why are we incurring this cost? Everything we start from zero. And the effect of this is that it takes a more intentional approach to managing the cost of the company. It forces people to have intention, to be intentional about managing the cost of the company. Obviously, it takes a lot of time to do this. That's the downside of the zero budgeting. And then driver-based budgeting focuses primarily on the key variables that most dramatically impact business performances. So we're going to look at what are the key drivers, and then we build a budget around that. Like the baseline assumptions about external drivers and the results-driven approach to internal business drivers. So we're looking at both external and internal drivers of the business. Okay, our time is really running fast. I don't even know what's happening. So why do we need to have a budgeting system? First of all, the budgetary system provides structure. It enables us to know if we're winning or we're losing, and it gives a way to measure if we're doing well or not. It helps us to predict cash flow so that we know when we need money and when we're cash flush. It helps us allocate resources. It also helps us model resources. Model scenarios. We can say, okay, if this happens to the economy and you are operating at 5% of our capacity, of our full capacity, what's going to happen? If we increase by this much, what's going to happen? And then it helps us, most importantly, to measure performance. This actually takes us to the behavioral aspect of budgeting, because if we're using budgeting to measure performance, obviously it encourages people to start massaging the budget so that, what is called profit smoothing, so that people appear to be hitting the budget, even if they are hitting the wrong budget, if that makes sense. Okay, so those are the behavioral implications of budgets. How the budget is administered is going to affect its effectiveness and efficiency in achieving the organizational goals. When a budget is used as a performance evaluation tool for individuals and performance, and when performance is linked to some sort of a reward or penalty system, then there is a possibility that the budget that we're going to get is likely to be massaged by managers, again, to achieve profit smoothing, as I've already said. So it leads to dysfunctional behavior. Budgets can bring positive behavior among people when the goals of individuals managers are found in conformity with the goals of the organization. But if those goals are then not in line with the goals, if your individual goals are not in line with organizational goals, we now do not have what is called goal congruence. If we don't have goal congruence, then we have the company trying to achieve goal A, but an individual trying to achieve goal B. It appears like the individual is trying to sabotage the goals of the company. Then another behavioral implications of budgeting is participative budgeting, where we bring in everyone to try and participate in the budgeting process. And the reason for doing this is to try and, first of all, gain as much insight from the people that are actually working on the ground, so that we build everything that they know into the budget. That is the advantage. And that tends to encourage people and give them ownership of the budget. They feel like it is their budget. If you impose the budget on people, they think, oh, well, it's your budget. You just told us that you want us to achieve this. We don't know. You don't get that much support of the budget from the people. Obviously, the disadvantage to that is that it takes longer, because if you have to involve everyone and everyone has their ideas and their preconceived notions of what's going on, and you can't make everyone happy. Another behavioral aspect is the budget tends to excessive pressure to exert pressure on people that are supposed to achieve it. If you've told people that we want revenues of 5 million and people are going to work towards that, and problem with that is what happens when people have achieved the target. They may relax and say, look, we've hit the budget. Whatever is remaining, we're going to defer to the next period, to the next budget period, so that we can meet the next budget period. That also links to profit smoothing, as I've already alluded to. Then there is what is called budgetary slack or cushion, where people build in more expenses into the budget than unnecessary, or where people reduce revenues in the budget than is necessary, so that they allow themselves to meet that budget. If expenses turn out to be higher, they have enough budget to absorb them. If revenue turn out to be low, they've already created low budgets. If the expenses don't turn out to be high, then they meet the budget. So that is another budgetary implication of a budget. Then a budget needs to have top management support. And people from the bottom are supposed to support the top managers in the budgetary process. And you can achieve that if you have participative budgeting processes. Budgeting sometimes can lead to interdepartmental conflict. I remember in one company, I should give this example, though our time is limited, when one department was running an operation and the other department was running people that are supposed to go to that activity that is being run by another department. So because of that, this one is incurring the transportation cost, which is supposed to bill the other transportation cost. And it's very difficult to have those two departments, especially if each manager is being measured on their performance. It's very difficult to have them working together in unison because of different performance measures that are exerted on them based on their performance. Okay. Obviously there are some criticisms to the budget. It's not a perfect thing. Other people have actually decided that, you know what, we're going to do away with the budget, in as much as it is important because of these criticisms. First of all, the advantages of a budgeting is that it transfers information upwards from all departments right up to the top management, and it also leads to employee motivation, as we've already alluded. It also leads to goal congruence, where everyone is working in unison because we have a common objective that we're trying to meet as a company. However, the process of budgeting is time consuming. It takes a lot of time to sit down and plan and do a budget. That's why other people just don't do it. That's also the reason why individuals don't do it. Then it also leads to budget slack, what I've talked about, that people built into the budget costs that don't exist, or they reduce revenues unnecessarily. Then the criticism to budgeting, it requires a lot of time. You have people that game the system. Then you have also outcomes blame, where other departments are not achieving and they're blaming it on the other departments. Sales are saying it's finance, they didn't give us enough money. Operations, production is saying it's finance, they didn't give us enough money. Finance is trying to manage the budget. Just everyone sharing blame or pointing fingers at everyone else. You also tend to have differences in expense in views of expense allocation. Finance is holding on to the bag. They don't want to spend money because they are managing the cash flow. But other departments are saying, for us to operate, we must get money. And then also the budget tends to consider only financial outcomes. It doesn't look at anything else that is not monetary related. Then it also can lead to strategic rigidity. What happens when we've hit the budget? Are we done? And also, people tend to work towards meeting the budget. Now we're going to cruise very fast in the remaining 10 minutes on forecasting. And the reason why we're going to move very fast here, because I felt this sort of borders around statistical probability and statistical models more than what we generally work with. However, we need to understand how that works. So forecasting is a technique that uses historical data as inputs to make informed estimates that predict and determine the direction of future trends. That's what forecasting is. So we look at what happened in the past, what is happening today, and we try and forecast what happens tomorrow. I thought the diagram that I put there is a good demonstration of what basically we're trying to achieve when we're forecasting. And for the record, those who are still asking in school why we actually ever needed to do statistics at high school and at university, it was really meant to help us forecast what is likely to happen in the future. Businesses utilize forecasting to determine how to allocate their budgets or plan for anticipated expenses for an upcoming period. This is typically based on the projected demand for goods and services. So that is what forecasting is all about. We're going to move very, very, very fast. There's a relationship between forecasting and budgeting. Budgeting and financial forecasting are tools that companies use to establish a plan for one, where management wants to take the business, and that is a budget, and where it is heading, and whether it is heading in the right direction. That is financial forecasting. Right. So there are various forecasting techniques that are used, and the two most common, actually, they are grouped into two categories. We have statistical forecasting or quantitative forecasting techniques, and then we have qualitative forecasting techniques. And on the quantitative forecasting techniques, basically that's where we use statistical probability to do it. There are several ways of doing it. The first one is a time series analysis. We look at the past data, we look at what is happening now, and then we try and project it into the future. And we are saying the past is going to influence what is happening now, and is going to influence what is going to happen in the future. Obviously, there is issues of correlations, because we are saying what is going to happen tomorrow is influenced by what is happening today, and is being influenced by what is happening yesterday, what happened yesterday. I'll give you an example of the rate of the rand that has been falling over the last probably 1 year, so to speak. You can see that the rate tomorrow is influenced by what the rate was today, and is what the rate is today, and is going to be influenced by what the rate was yesterday. So that is a time series analysis. And then another way of forecasting using statistical approach is using causal forecasting. Those who know, those who remember from statistics, this is where we have the y equals to bx plus a. This tries to establish a causal relationship. That's why the dependent variable is influenced or is affected by whatever happens to the x, which is the independent variable. And we've tried and find the coefficient of correlation between the two variables, which is the slope coefficient. Okay, again, this is not a statistical, this is not a mathematics lecture. So, but that's what we do. So we try and find the causal relationship between x and y, and then we use the variable x to determine what the variable y is going to be. I'll give you an example. The example that I like to give is, depending of whether you like pizza or not. If you love pizza, you know that the amount of pizza that you're going to eat in a given month is determined by your salary. So the higher your salary is, the more the pizza you eat. However, if you eat sugar, the amount of sugar that you eat is never going to be determined by your salary. You're not going to suddenly eat 10 kgs of sugar a month simply because your salary has gone up by 100%. So the coefficient of correlation between sugar and your salary is very low compared to sugar and pizza. I hope this example sheds more light. So that is on the causal relationship, on the causal forecasting. And then we also have qualitative forecasting, where we use, I'm not going to dwell much on this. We have 4 minutes left. We're going to look at the market research. There is the Delphi method. There is the panel method. I don't know how many of us here have been called to, when other people are doing market research, or even questionnaires that we have, where they send you a questionnaire if you're an expert in a certain field, and then you complete, and they are trying to gather qualitative information that helps them forecast. So that is forecasting. And normally, forecasting is a very expensive process, because you must bring in experts. If you're doing quantitative forecasting, you must bring in people that know how to use statistical tools that are used for forecasting. And then it also involves collecting data. If there are any PhD people here, or master's people here, you know that when you're doing research, you needed to collect data. You needed to have a sample of data and make sure that the sample is representative of the entire population, gather information from that sample, and then try and project that information into the entire population. Oh, again, I'm talking to accountants here. We do that all the time when we're auditing and we're using sampling tools, right? We take a population from the sample, we define the sample parameters, and then whatever we get from the sample, we project it to the entire population. So that is that is forecasting. So we use that to determine if this is this today. What is it going to be like in the future? So researchers, they use either qualitative or quantitative techniques for sampling. Quantitative techniques are used, but not so much because of the drawbacks that they have. People change their responses, and in any case, if you have qualitative data, you're still going to try and assign quantitative variables to the qualitative data that we have, so that you can put it in a quantitative model and project it into the future. So I think, without going much into the field of statistics and statistical forecasting, this is what I can say about forecasting. And we can, if you download this, I went into much detail about everything that we covered here today in this webinar on the lecture notes, because I knew that the topic was very wide, but the time was very limited. So I needed to cover as much and try and explain what I think is going to be you'd need to know to understand it, especially when you're now reading through the lecture notes. Download the lecture notes, go through them. I think they're fairly detailed. You should really be able to understand it. And my hope is that we're able to apply, especially the planning part and the budgeting part, into our organizations. If your organization was not planning or budgeting, it's a good time to actually introduce this into your company and start budgeting. If your organization was already budgeting and planning, but it was one of those where the budget is created, but no one actually ever looks at it, I would say go back, review, revise the budget, take a look at it this year as you are going to be involved in the budgeting process for the upcoming year. Just go through it, interrogate the budget, see the numbers, look at the actuals, see where your budget makes sense, where your budget doesn't make sense, and try and start using the budget as a tool for actually managing and controlling the business, more than just it being a tool that sits on the shelf and gathers dust. Thank you very much all for participating. It was good. I had a very engaging audience. It was very lovely talking to you all. And my apologies again for rushing this. Our time was very limited. So we needed to do what needed to be done to cover ground. And I wish you all the best in this festive season. Be safe. We'll meet again sometime beginning of the year. Enjoy the rest of your day. Bye.
If you have any other questions, please use the chat. If you would like to email a question, please email to technicalquestions@accountingacademy.co.za. Thank you for your participation. We hope to see you next time.